What if I was to tell you one of the most common pieces of investment advice, subtract your age from 100, or the newer, 120 minus your age, is actually a dangerous advice that can cost you thousands or even millions of dollars over your lifetime? Here's what most people don't realize. Studies show that asset allocation drives between 70 to 90% of your investment performance. This means how you split your money between stocks, bonds, and cash matters far more than which specific fund you pick. Yet most investors barely spend any time thinking about their overall asset allocation. Why is this? It's because it's a lot to think about. But think about what happens when we don't. A 30-year-old using a 120 minus age rule would put 90% in stocks. A 60-year-old would put 60% in stocks. But think about this. Should every 30-year-old really have the same portfolio? What about the 30-year-old professional with zero debt versus 30-year-old with student loans and job uncertainty? What about the 60-year-old with a sizable nest egg who wants to leave money to their kids versus one who needs every dollar for retirement? The truth is that age is just one data point, and in my humble opinion, not the most important one. So let's dive into 3 factors that actually determine your ideal asset allocation. Factors that matter way more than just your birthday. But before we get there, just in case we haven't met, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The first factor that trumps your age is your actual time horizon. And this isn't just about when you plan to retire. It's about when you need to access specific buckets of your money. Here's where most people get this wrong. They think of their entire portfolio as one big pot with one retirement date. But in reality, you probably have multiple financial goals with completely different timeline. You might need money for a house down payment in 3 years, while your retirement fund won't be touched for 30 years. These buckets should have totally different allocation. Let me break down some time horizon rules that actually work. In your first bucket, you have your short-term money. Essentially money you need in the next 12 to 36 months to pay your bills and cover your living expenses. And a good part of this should be held in cash. Good options are a simple checking account, money market accounts, or high-yield savings account. You need this money to be liquid and quickly accessible. In your second bucket, you have your midterm money, often money you need in the next 3 to 5 to even 10 years. You can take slightly greater risk with this money, but not so much. Good options are again money market funds, CDs, or bonds if you want to take a bit more risk. And in your third bucket, this is where you have your long-term money. This is money you're not going to need for 10 plus years. And the best recommendation is to be heavily invested in stocks. And this is where you can start being aggressive because you have time to ride out the inevitable ups and downs of the market. Here's a real example from my own life. I keep our spending money in a simple checking and savings account. I have money for our midterm targets in either CDs or bonds. And my retirement accounts? Those are heavily weighted towards stocks because I won't touch that money for decades. Now, the reason time horizon matters so much is simple. Stocks are volatile in the short run, but powerful in the long run. Over any single year, the stock market can be down 20, 30, even 50% or more. But over a 20 to 30 year period, stocks have historically outperformed bonds and cash. Think about it this way. If you put money you need next year into stocks and the market crashes, you're forced to sell at the worst possible time. But if you won't need that money for 15 years, you can ride out multiple market cycles and benefit from the long-term appreciation. This is why blindly following age-based rules can be so dangerous. A 35-year-old saving for a house down payment should treat that money completely differently than their 401k contributions. The house fund needs to be conservative regardless of their age, while the retirement money can be aggressive. One more crucial point. Your time horizon can change, and that is totally okay. Maybe you thought you would work until 65, but now you want to retire at 55. Or maybe you're 28, and suddenly decide you want to buy a house in 3 years instead of 10. That is totally fine. Just make sure that you're adjusting your asset allocation to reflect the new time horizon. Now, before we dive into the next life stage, there's something really special I want to share with you. For those of you who want more hands-on support as you navigate your asset allocation, I want to let you know about an exclusive program. Introducing the Financial Tortoise community, and it's now open for waitlist signups. The community is your ultimate roadmap for mastering your money, systematizing your finances, and securing your family's financial future. Close to 15 years ago, my wife and I were completely broke. We not only unwisely spent all of our savings on an expensive wedding, but we were buried under $105,000 of student debt. Financial anxiety was a daily reality. We constantly worried about money because we couldn't see a path forward. Well, by learning from some great financial mentors, we were not only able to learn how the truly wealthy manage their money, we were able to work our way through our 6 figures of student debt and eventually achieve financial peace. And I want to share everything I learned with you through this special offer. Inside the community, you'll find a structured path to building lasting wealth designed specifically for professionals who want steady, sustainable growth without hype or unnecessary complexity. Exactly the stuff I talk about in this channel. The Financial Tortoise community includes personal, one-on-one coaching sessions with me, where we'll address your specific financial questions and create a personalized plan aligned with your goals. Step-by-step member-exclusive courses on everything from developing the right money mindset to designing your ideal investment portfolio to minimizing taxes. Monthly live Q&A calls where we dive deep into key topics and keep you accountable. A private forum connecting you with other hardworking professionals on the same wealth-building journey as you. Practical tools, templates, and resources that simplify your financial decision-making. And I'm especially excited to offer members a complimentary subscription to Monarch Money, a powerful financial tracking tool that helps you organize your accounts, track spending, and visualize your progress all in one place. This alone represents significant value, but it's just one of the many resources you'll have access to. However, to maintain the quality of support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community to be first in line when the doors open next. Plus, a special bonus for joining the waitlist today. You'll receive a free special gift delivered straight to your inbox automatically just for signing up. Remember, real sustainable wealth is not built overnight. It's created through slow, consistent effort that compounds over time. Exactly what we focus on inside the community. Many members have completely transformed their financial lives, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. The second factor that matters more than your age is your financial resilience. Basically, how well can you handle life's inevitable financial bumps without derailing your investment plan? I like to think of this like the suspension system on your car. In the game that we call life, we all hit potholes. Unexpected expenses, job losses, market crashes. Now, if you have good financial suspension, these bumps are manageable. Nothing but small annoyance. However, if your financial foundation is shaky, every little bump threatens to knock you off course. Thus, your financial resilience determines your ability to take investment risk because it answers a crucial question. When bad things happen, will you be forced to sell your investments at the worst possible time? Let me give you an example to emphasize this point even further. Let's say you're a 30-year-old, so the age-based rule says you should have 90% in stocks, but you have no emergency fund, $50,000 in student loans, and unpredictable income. What happens when the market drops 40% and you lose your job at the same time? You're forced to sell your investments at rock bottom price just to pay your bills. You just locked in those losses permanently. Compare that to another 30-year-old with 12 months of expenses saved, no high interest debt, and stable income. When the same market crash happens, they can actually buy more stocks while they're on sale. Same age, yet completely different ability to handle risk. This individual could have an asset allocation of 100% stocks and will be completely fine. Alright, so let's break down how to develop greater financial resilience if you want to take greater risk in the market. First, your emergency fund. This is your first line of defense. If your water heater breaks and costs you $2,000 to replace, do you have cash to handle it, or do you need to sell investments? You don't want to be caught in a situation where you have to sell your investments when the market is down. Thus, the general rule is to have 3 to 6 to even 12 months of expenses saved. But your situation might call for more or less. If you're a freelancer with unpredictable income, you might want 12 months. If you're in a position with solid job security, less could work. Second, your debt situation. Simply, if you have high interest debt that you're still paying off, you're not standing on strong financial footing. If you want greater financial resilience, so you can take greater risk with your portfolio, you want to get gazelle intense and try to pay off that debt as soon as possible. Third, your income stability. Are you a tenured professor, a software engineer at a stable company, or a real estate agent whose income swings wildly with the market? More stable income usually means you can take more investment risk because you're less likely to need those investments during a bad market. Fourth, your insurance coverage. This isn't sexy, but home insurance, health insurance, and appropriate life insurance to protect your financial plan from catastrophic events. For me personally, the most important question for measuring your financial resilience is this. If my investment portfolio dropped by 50% in value tomorrow, would that force me to change my lifestyle or sell investments to pay bills? If the answer is yes, you might need a more conservative asset allocation regardless of your age. Remember, the most aggressive portfolio in the world will not help you if you're forced to abandon it during the first market crash. A more conservative portfolio that you can stick with through thick and thin will always beat an aggressive portfolio that you panic out of. Your financial resilience is not about your age. It's about how prepared you are for life's curveballs. The third factor that trumps your age is your actual risk tolerance. And I'm not talking about some online quiz that asks you if you're conservative or aggressive. I'm talking about how you actually behave when your portfolio is getting crushed and the financial media is predicting the end of the world. This is the most psychological factor, but it might be the most important one. Because here's the brutal truth. The best investment strategy in the world is worthless if you can't stick with it when things get scary. If you've been investing through a few market cycles, the best way to assess your risk tolerance is very simple. Look at what you actually did during those market crashes. Think back to March 2020 when the market dropped 35% in 5 weeks. What about 2008 when stocks fell over 50%? Did you stay the course or did you sell some of your stocks? Did you panic and sell everything? Or were you one of the rare investors who actually bought more? And be honest with yourself here. There's no shame in admitting you sold during a crash. Many people did. But if you've historically been a panic seller, don't set yourself up for failure by building an aggressive portfolio you won't be able to stomach. Remember, risk tolerance is not just about the numbers. It's about finding an approach that works for you, your personality, and your stress level. If you're new to investing and have not been through a real bear market, here's my recommendation. Start with 95% of your money in a strategy you think could work for you. This could be all-in total stock market index fund, an allocation between bonds and stocks, or the BOGO Hedged 3-fund portfolio. Set up automatic investing and don't touch it, especially when the market seems to be going wild. Then take the remaining 5% and buy whatever interests you. Actively managed funds, individual stocks, or even commodities. Think of this as your learning account. You'll probably make some money and lose some money, but more importantly, you'll learn how you react to volatility. Do you check the prices obsessively? Do you want to sell when things go bad? Or do you find it exciting when your investments go on sale? This learning account also serves another purpose. It scratches the itch to do something. Many people have a hard time just buying a simple index fund and never touching it. They want to feel involved. They want to feel like they're doing something. Well, if you have this tendency, give yourself that permission by having a small speculative portion of your portfolio, which allows you to tinker and learn without jeopardizing your long-term plan. And here's a key insight. Your risk tolerance might be different from your risk capacity. Maybe you have a 30-year time horizon and a rock-solid financial foundation, so theoretically, you could handle an all-stock portfolio. But if market volatility keeps you up at nights or make you want to sell during crashes, then your risk tolerance is lower than your risk capacity. In that case, follow the lower number. It's better to have a 70% stock portfolio that you stick with for 30 years than a 100% stock portfolio that you abandon after the first major crash. Consistency beats perfection in investing. Bottom line, your risk tolerance is all about knowing yourself. Age-based rules cannot tell you whether you're the type of person who panics during crashes or buys more when stocks go down. Only you know that, and that is the most important factor of all. Alright, so we talked a lot about various elements that drive your asset allocation, so let's bring them all together. To summarize, here's how to actually apply the 3 factors. 1. Start with your time horizon. Map out when you need different buckets of money. Anything you need in the next 5 to 10 years should be in bonds or cash, regardless of your age. Everything else can be more aggressive. 2. Assess your financial resilience. Be brutally honest about your emergency funds, debt levels, income stability, and insurance coverage. If any of these areas are shaky, dial back the risk until you shore up your foundation. 3. Know your risk tolerance. Look at how you actually behave during market stress, not how you think you'd behave. If you're new to investing, start conservatively and learn about yourself through experience. Then combine all 3 factors. Longer time horizon plus stronger financial foundation plus higher risk tolerance equals more stocks. Shorter time horizon, shakier finances, or lower risk tolerance means more bonds and cash. Here's a simple framework. If all 3 factors point towards aggressive, you might be comfortable with 90 to 100% stocks. If they're mixed, maybe 70 to 80% stocks work better. If all 3 suggest conservative, you might be looking at 60 to 70% stocks. The beauty of this approach is that it's actually personal. It allows your allocation to reflect your unique situation and not be based on some generic formula based on when you were born. And remember, you can always adjust your allocation as your situation changes. Once you're debt-free, you can take more risk. Or you realize you want to retire earlier than you initially thought. No problem. You can dial back your stocks. The key is to recognize the factors that drive your asset allocation and make adjustments as necessary. Thank you guys for watching the theme of asset allocation. If you want to learn some of the popular lazy investment portfolios out there, please check out my video here. Until next time, all the best.